Hello, everyone. I hope everyone has had the opportunity to get a coffee or check some emails or stretch a bit. So we're back now for our final panel of the conference to talk about climate finance and how we're thinking about moving capital into this sector to finance all of these goals and objectives that we all recognize as so necessary. So we're going to talk about the opportunities and hurdles in this sector. And to do so, we're going to be led by Claire Hirons, sorry, Claire, if I've mispronounced that, who is the Senior Program Manager at the Loudest Foundation, working on these very salient issues. So Claire, I will turn the floor over to you now.
Brilliant. Thank you, Brooke. And very, very pleased to be here. Loudest Foundation is relatively new, but we're doing a lot of work with the finance sector. It's a fantastically important part of the economy and increasingly seen as a big lever for change in the climate debate. So we fund right across the board, and I'm fascinated to see we've got a fantastic panel here today. So finance is vital to the transition. I think you've been hearing a lot about the transition today. On one level, investors are the owners and the governors. On another level, they're bringing the money to bear that will steer the real economy towards success or failure. So we've got COP fast approaching, just a couple of weeks away, and there's a lot in the media about companies and investors committing to net zero, but we're all on tenterhooks to see what will happen after the event and whether these commitments will actually lead to action. So in this panel, we're going to explore what the transition actually means to the investor community, and why it should be taken very seriously from a financial and broader perspective. We've got some discussion on what the role of ESG is and whether it will get us to net zero. We've got a speaker on how investors will actually build net zero portfolios and how they'll be able to tell and measure whether it's working. We hear a lot about shareholders, but we want to talk a little bit as well about debt and the fixed income side of the equation. And then we're finally finishing off the suite of talks with the role of collective engagement and how investors are beginning to join forces. So the way we're going to play this, I think probably similar to other panels, each of our speakers has got an opening statement, a few things to share with us, and a few thoughts. I'd like to run through each of them in turn, if that's okay with everybody, and then we'll turn the session over to questions. As we go along, be delighted if people can put questions into the chat. We'll collect those up and bring them in when we open the floor. So without further ado, I'd love to introduce you to Henrik Jepsen, who is Head of Investor Outreach for North America at the Carbon Tracker Initiative. Henrik is building awareness and understanding of carbon and stranded asset risk among the institutional investment community, and brings more than 20 years of experience in the energy and financial services sectors. So over to you, Henrik.
Thank you so much, Claire, and thank you so much to Columbia for this opportunity to bring in and discuss a couple of things on this incredibly important topic, and especially as we have COP coming up, so that's a good segue here. I prepared a couple of slides, which I'm trying to see if I can share, and then please let me know if we had a successful. So can you see a front page now, or can you see like a presenter's view here? What can you see?
We can see the presenter's view at the moment.
Okay. Yeah, then we try with this one here instead. So now you can see just the front page, which both has a bad news and a good news commentary here. Okay, can you see nothing now?
We can see you.
Okay, well, I will spare you for that. So I think we go over to this one here instead here. So perfect. Fantastic. So here we go. So again, sorry for this, and thank you to everyone. So as mentioned, my name is Henrik Jepsen, and I'm the Head of Investor Outreach for the Carbon Tracker Initiative. I'm focusing on investor outreach in North America. For those who are not aware, Carbon Tracker is a London-based independent financial think tank. We are focused on analyzing the implication for capital markets from the energy transition towards a low carbon economy. And we do this by identifying, quantifying stranded asset risk, a concept that we developed a little more than a decade ago, and we continue to work on performing scenario analysis, analyzing trends in energy technology and energy disruption, and we're working with financial regulators, standard setters, and investors such as CA100 Plus, Climate Action 100 Plus, and others, as we will hear more about later in the discussion. So Carbon Tracker in a nutshell, if you take it like this, we really work with two narratives. One, we can't burn it all. That's where we came from. Emissions from greenhouse gases will need to fall significantly, as our guest has been discussed at length early in the program today, if we are to avoid the catastrophic levels of global warming. And such constraints will have very profound effects on the demand and supply of fossil fuels, which are the biggest source of human-led carbon emissions out there. This limited carbon budget, as climate scientists have defined, means that higher cost assets will have a higher risk at destroying value in an energy transition, and hereby comes the stranded assets. So this was all the bad news, essentially. The good news is that we won't burn them all. There's already a lot of ongoing energy disruption happening. New energy technologies are happening, driven by air pollution and import dependency, which are all leading to a rapid decline in renewable costs, things I will come back to a little bit further. Why is this important for climate finance and for the financial markets? Well, market discount future expected profits. When they see a turning point or a peak, market derate the impacted stocks or re-rate the areas that are going to benefit. Therefore, investors must pay attention now when we are seeing more and more areas entering or being very close to peak fossil fuel demand. And investors can do this by refocusing their efforts on energy transition winners. They can engage or influence fossil fuel companies to change and to avoid risk. They can divest the stock, or they can divest the management, or or replace the management. So these are really where we are coming from in a very short order. Just to put a little bit more context on it, unfortunately, climate the world is currently on a wrong pathway. Hopefully, COP is going to put us more on the right pathway, but fossil fuel producers are still planning for growth in fossil fuel supply. In May of this year, 2021, IEA, the International Energy Agency, published their net zero 1.5 Celsius temperature scenario to be reached by 2050. And that made it very clear that no new oil, gas, or coal project should be approved. Pause a little bit here. That's a very important factor for a lot of these companies, especially as we see the spaghetti chart here. There, more or less everybody is planning some kind of growth in here. In a recent report by Carbon Tracker called Adapt to Survive, we ran an analysis looking at the 40 largest oil and gas listed companies and saw what will happen if we only looked at their decline rates. And that really came that more than half of these companies would see a 50% or more decline in their oil and gas production. That raises big questions on how are they going to replace their earnings and cash flows, and whether this is factored into valuations. It's no longer business as usual. 70% of global GDP, including US, UK, EU, China, etc., have made some kind of commitment, consideration, and said they are going to aim for net zero. I think we even saw Saudi Arabia yesterday come up with their ambition, although it's not including oil and gas business, so it's a little hard to see why that really is having a big impact. We have more than 20% of the largest publicly listed companies have made some commitments, representing more than $14 trillion in annual sales. The oil and gas sector wrote down $150 billion or more in fixed assets during 2020 and during COVID. We saw a lot of radical changes in business models. Regulators are paying attention, starting to make the TCFD more mandatory, especially driven by the UK. And lastly, we saw that we have seen over the last decade we have seen a 90% decline in the price of solar and battery cost, and around 60% for wind energy. So all of this means that really it's not really all bad news. There's a lot of things changing, and this is extremely important for investors. Just to highlight here that the air pollution, really a lot of the focus here is around climate, but actually a lot of this is driven by air pollution. 8 million people are dying every year from air pollution, and around 80% of the global population lives in countries that import their fossil fuel energy. So in short order, they're exporting capital and jobs while they're keeping health, pollution, and climate issues. China and India are the two biggest ones. In the next 2 decades are expected to import up to 80% of their future energy production, or they could look at producing this domestically. And this is one of the things that we are believing is really a big driver here. Renewables are a deflationary item. It's technologies, mass production, economies of scale. Henry Ford taught us all of this by the assembly line and really driving down cost. Fossil fuel is really inflationary. My background is from the dark side, being on the investment banking side, raising a lot of money for oil, gas, and coal, oil and gas companies, primarily in the Nordic region. And really one of the key factors here was we had to go longer, further, deeper. All the low-hanging fruit has been picked, so therefore the more expensive areas remain out there. And all of this is before we include any cost for carbon emissions or externalities. So really what it leaves us is in a world of peak fossil fuel demand. We've already seen a number of peaks happening. Actually, 15 years ago, we saw the peak demand for fossil fuel for electricity generation across the OECD. We have peak coal, peak E&P capex, peak gasoline car, and some will say, including us, that we probably saw peak oil demand in 2019. Time will tell. This is going to continue to have a big impact. Falling renewable cost and peaking fossil fuel demand open a big window for policymakers that changes the focus away from somebody that's favoring the current fossil fuel driven system to some that favors more on the energy transition. And this is going to be very important in the future for energy technology leadership, geopolitical issues, etc. All of this is not going to happen at once, but it's happening in sequencing, countries by countries, sector by sectors. As you can see here on the left-hand side, Denmark, Germany, and Morocco don't have like a unique technology that nobody else have access to, but they have been longer. They have had more experience at deploying renewable technologies. These experiences, these learning effects can be spread in other markets, creating a lot of growth opportunities. So although we say that we might not have solutions today for the last 10-15% to decarbonize the industrial system, then just remember that 10 years ago, between 10 years ago and now, our battery cost and solar cost have fallen around 90%. So we can actually get a long way by just using what's already out there and get up these learning curves. The fossil fuel system is huge. It has a very big impact across the board. Basically all what I have talked about here has a big impact on the incumbent fossil fuel dependent companies, everybody producing, everybody in the supply chain, both before and after, and everybody who is financing these companies. You can see the numbers. We put a report out last year, more than $30 trillion worth of physical assets, a quarter of listed equities, and roughly half of non-financial bonds are non-financial sector bonds are impacted one way or the other by this upcoming change here. So to wrap up here, energy transition creates a lot of risk and opportunities. This is a big opportunity for investors. It's taken us 200 years to build a massive fossil fuel driven system that has done a lot to create our prosperity as we know today, but now it needs to change, and we have the tools to make sure that this is happening. And then lastly on COP, just wanted to highlight here, based on everything I've said here, it's very important that we actually start to also change the focus of what has been the case with COP. just 6 years ago now, in 2015, the world looked very different than it does today from an economic point of view. And we really want to highlight that mitigating climate change is no longer an expensive collective action problem, but it's a technology revolution with enormous wealth generating and redistributive potential that is very important for investors to focus on. With that, I want to hand back this screen to somebody else, and looking forward to the following Q&A. Thank you, Claire.
Fantastic. Thank you, Henrik. That was amazing. Very heartening. It feels like change is coming at a very fast pace. And I want to, and I'm delighted to introduce Aniket Shah now, who's the Managing Director of Global Head of Environmental, Social and Governance and Sustainable Research at Jefferies Group, LLC. Also very, very widely published. And I wonder if now I could hand over to Aniket to talk to us about what is this thing ESG and what role does it play in the transition?
Claire, thank you very much. And first of all, let me just thank Columbia University and our dear friend Lisa Sachs and team for bringing us all together, which she does and her team does so well. I think CCSI will go down as the most important research organization working on climate and ESG and sustainable finance, and that's in large part to her leadership. So Lisa, thank you. And I also want to say it's a pleasure to be here on a panel with so many people that I've admired for a long time, people whose work I have learned from and continue to learn from. And Henrik, Laura, Segafredo, and others, these are the very best people in the industry. So it's a complete pleasure and privilege to be here. What I will do is I'll just lay out 4 main ideas that help, I think, clarify where my mind is on the topic of ESG and climate. And I'll go for just 5-6 minutes, if that's okay, Claire. And let me start by saying what I do, because it'll help people understand the perspective that I have. So I run ESG research for the 7th most active investment bank in the world. So what does that mean? It means I spend all day talking to the largest pools of capital, helping them think about what do the topics of ESG and climate mean for their investments. And I also spend a large part of my time talking to corporates, because investment banks sit right in between investors and companies. And we are basically providing information to help bring the two together. That's what investment banks do. And research departments provide the intellectual content of a lot of that kind of engagement. And I sit within a research department of 300 publishing analysts who are very different. Their minds are constituted very differently than mine, because all day, all they do is study companies, and they go down to the nth level of detail. These are people who will spend 20 years covering 20 companies. That's it. That's what their focus is. And so a large part of my job is marrying the knowledge that my team and I have on climate and ESG with their very, very deep micro expertise on companies, and then going out and talking to investors together for people who are, again, not necessarily interested in the big picture, always on climate, but down to what does it actually mean for specific companies. So I want to just say 4 things, and then I'll just give a minute for each and then go from there. The first is that ESG and net zero are, I would argue, completely different topics. We have to think about them differently. They use different tools, different analyses, different frameworks, and so on. And I want to drive a hard distinction between them. And for the sake of argument, I'm going to drive a very hard distinction and know that I'm being a little bombastic because I want to make the point. The second point I want to make is that when we talk about quote unquote investors, I want us to be a little more clear about what type of investors we're talking about. Are we talking about public sector investors, meaning the government, states? Are we talking about private investors, meaning people who are looking to make a profit? If we're talking about private investors, are we talking about asset managers? or are we talking about asset owners, or are we talking about corporates? All of them are investors, or banks, by the way. And then for each one of them, there are many, many different types of capital providers. And the reason I say this is that I think we've become a little lazy when we talk about, in quotes, investors. And as someone who on a daily basis talks to all of these different types, I can tell you they're effectively different entities. I mean, it's strange to even talk about them with one word. So that's the second point I want to make. The third point I want to make is a need to focus on emerging markets, that we have to bring emerging markets and the so-called developing world, a term that I really don't like to use, but unfortunately it's one that our industry uses, so I'm going to use it for the sake of clarity, that we need to spend more of our time talking about EM than we do developed markets, just in general. It's sort of been lost. And the fourth point is I want to talk about, do we look at this from a risk perspective or from an opportunity perspective? Okay, so very quickly, what is ESG? ESG investing is about taking a full picture of a company into account when making an investment. It means doing a deeper, more fundamental analysis of all the risks and all the opportunities that are linked to a company. ESG is not necessarily about climate and the environment, right? I mean, we do ESG work with biotech sector, ESG with consumer sector, where the issues that are material for those sectors are completely different than for the oil and gas industry. ESG is also not about having a specific goal in mind. ESG is not about decarbonizing the world. It is, while the world is trying to decarbonize, are you as an investor taking risks and opportunities of that decarbonization effort into consideration when making a investment decision? So there are a whole bunch of frameworks around that, and there's something called SASB, the Sustainability Accounting Standards Board, that helps identify material issues by sector and subsector, et cetera. Net zero, which by the way isn't a great term itself, but it's the shortcut that we're all using, is about transforming the entire global economy to one that doesn't emit 51 billion tons of CO2 and their equivalents, but brings that down as quickly to zero as possible, which is a massive transformation. I mean, let's not fool ourselves. It's a 4 to 5x increase in clean energy investments per year. It requires a different set of interventions from the state, from private sector entities, et cetera, et cetera. So I want to just talk about those two differently, and know that the investor world talks about them increasingly as two separate conversations. The second point is about the lots of different types of investors. If you're talking to a pension fund in the US, it is a fundamentally different conversation than a pension fund in Europe. If you're talking to a pension fund in the US, it's a fundamentally different conversation than with a hedge fund. If you're talking to a hedge fund, it's a completely different conversation than with a private equity firm. If you're talking to a private equity firm, it's a completely different conversation than with a bank, and so on. And, you know, we don't, unfortunately in this space, we don't talk about institutions enough. I'm a big believer in the study of institutions and the fact that we need to have a conceptual mapping of the different institutions of finance to be better analysts on this topic. And so much of my work is actually understanding how these different capital providers operate. What are their incentives? How are they functioning? What are the regulatory constructs within which they operate? What are their goals? And then within that, trying to bring the ESG and climate conversations as separate conversations to that. And unless we do that, I think we'll be continuing to talk in circles. And since we're in an academic environment, I want to stress the point of clarity, focus, specificity, and definitions when it comes to that. The third point is around emerging markets versus developed markets, which is to say that emerging markets are carbonizing. They are not decarbonizing. They are going into carbon. They're not going away from carbon. The CO2 emissions in terms of production, consumption, exports, et cetera, of emerging markets is growing. It's not declining. And we in our minds, I think, and look, this is no great insight of mine. That's just the numbers. We are seeing live today on COP26, like we have for every year since we've been talking about climate, an enormous outcry from so-called emerging markets saying, hey, you need to support us through this transition because we are starting at a very different starting point than the US or Europe. Again, it's nothing that is a great insight, but it's something that we forget. You know, the per capita CO2 emissions in India is around 2 tons. That number is 20 in the US and around 9 in Europe and China. So the whole talk about, and there was some very hard-hitting stuff coming out from the Indian government recently saying, you need to fund us, the world has to fund us in the order of trillions of dollars of grants and highly concessional funding for us to get on board. It's funny, we can't just dismiss that. That's not just posturing. This is real stuff, right? This is, let's get real about this. And I think we in the investor world, in quotes, we don't apply the thinking of starting points enough when thinking about how investors need to be engaging with these different parts of the world. And I think we're missing a lot there. And then the fourth point is about risks versus opportunities. My dear friend and colleague Lisa Sachs always, and I'm going to butcher what she says, but always makes a great point that when we talk about risk here, we can't just be talking about the acute risk for company X or asset Y, but we should be talking about the systemic risk of what happens if we don't solve this problem. And I think it's a wonderfully clarifying point. Investors, unfortunately, though, don't have systemic risk in mind. They're not paid to do that. That's not their mindset. You know, if you're a portfolio manager at name the firm X, you're thinking about the risk or return on the assets you're investing in, or maybe the portfolio that you're investing in. You might be considering broader systemic risk, but even if there are systemic risks, it won't necessarily impact your portfolio more than others. So I think the risk question, we have to be very clear about whose job it is to think about what risk. And on the opportunity side, all I can say is that every investor that I talk to all day, every day, is thinking about how do they make money from investing in the solutions. You don't need to tell any investor anymore, look, Elon Musk is the richest man in the world and he made his money trying to bring a solution to climate change. The idea that you can make a ton of money investing in these solutions is very clear. So just some high level thoughts of where I sit and where I sort of see things. And Claire, I'll hand it back to you to continue the discussion. Thank you.
Fantastic. Okay, that was a brilliant run through and some very salient points there. We may come back to that question of emerging markets and what we're sort of throwaway calling the just transition, but I'm not sure any of us really know what that means in practice. So I'm going to pass over now to Laura Segafredo, which I hope I've pronounced right, I'm sure I haven't, but Global Head of Sustainable Research, ETF and Index Investments at BlackRock. So Laura focuses on climate change risks and opportunities and has spent over a decade working as both an economist and researcher at a variety of institutions, including ClimateWorks Foundation, the Earth Institute at Columbia, and 2 Degrees Investing Institute. So coming with a wealth of experience. Laura's going to talk to us a little bit about what this means in practice for investors that want to build a net zero portfolio, bearing in mind Aniket's comments about the nuance of what that means, how to construct the portfolio, how to measure it, and where indexes come into play. So if I could pass over to you, Laura, that would be great.
Yes, thank you so much. It's a pleasure to be here today. Thank you for having me. Thank you, CCSI and Lisa Sachs. And obviously I can only echo Aniket's comments. It's always fun to be on a panel with some of my favorite people, including him and Henrik and so many of you today. So thanks for having me here. Henrik and Aniket also brilliantly framed the issue here. I just want to maybe talk about 3 or 4 things to sort of set the stage for how we think about it in my role at BlackRock, and specifically sitting on the sort of most liquid public markets and also sometimes problematic part of the business. So first thing, I mean, we've been very public about it. You've seen it in our client letter in January and in the letter that Larry writes that everybody seems to be reading these days. But our position is very clear that climate risk is investment risk. What does that mean? It means that investors who don't consider the effects of climate change on the global economy and on asset prices aren't seeing the whole picture. That's particularly important for us, obviously, because we are invested in the global economy. As Aniket said, this is also opportunity, by the way. Why? Because this transition to a low carbon or a net zero economy, I also don't love the name, but that's what we have today, will be one of the deepest and most significant in human history, basically since the Industrial Revolution. And also this is going to happen much, much more quickly than the Industrial Revolution. In order to achieve global decarbonization in the next 30 years, we will see a really giant amount of capital reallocations. A lot of money needs to move in the right direction to the tune of something like $50 to $100 trillion, right, over the next 30 years. So that's obviously a massive opportunity for investors such as ourselves and for our clients. Now, obviously, I also want to emphasize that two things. First, that given the ambition, given what the end point is, which means an economy that basically is able to function with no carbon by 2050, which is very big departure, again, from how we've done things so far, there's no way this will happen unless governments play a role. I just want to emphasize this as big a role as financial institutions play in the world today, obviously as capital allocators. The size, the speed, the scale of this transition, the amount of money that needs to find its way to the right use is just so massive that there's no way this can happen unless governments do their job for a number of reasons. Just to give you a sense of the scale, right? Every year, the world spends somewhere between 5 and 10% of GDP in infrastructure, just in maintaining and replacing existing infrastructure. And then an additional 8 to 10% in just purchasing energy. So we're looking at 20% of the world's economy that needs to shift to an entirely different model. So that's the amount of money. Just the size of these investments obviously should make sound energy and climate policy a priority everywhere, right? There's no energy or climate strategy that can succeed unless these expenditures are channeled into wise choices at scale. So that's another important thing. So as important as financial institutions are, we need governments to do their job. The other thing I want to emphasize is that, and Henrik has had a very sort of optimistic presentation, and I think that's great, but I think we also need to sort of remind people that there's a gap in currently between the ambition that's stated by countries. There's a lot of announcements around meeting net zero goals between 2050 and 2060, depending on the region. That's all great. We see a lot of companies. To some of the latest count, like 80% of the S&P 500 constituents have announced some plans for becoming net zero by 2050. Those are great. But still in this world, and part of it is because governments clearly need to also increase the ambition, but still in this world, we're headed towards between 2.5 and 3 degrees of warming in 2100. So we're not on track to meet our Paris goal. So I just want to emphasize that. Clearly, there's an important event happening next week, in the first half of November in Glasgow, which is COP26, which is an important one because it was supposed to happen last year as a sort of 5-year post the Paris Agreement, as an opportunity for countries to come together again and really think about ratcheting up ambition versus 2015 and what was announced back then and the policies that have been implemented since. So there's hope, obviously, that with this effort, we will manage to lower that temperature again, right, of that thermometer of where we're going to be in 2100. But again, it's a pretty Herculean effort. So I just want to put it out there. It's a lot. It's a lot of effort that's needed, and it's a lot of change that's coming. Now, having said that, I guess like the other thing that I wanted to emphasize is that we're optimistic, and we think also, honestly, I also think that there's just no way this can't happen. We basically have no choice at this point, right? Like I also want to put it out there. If today we're living in a world that's 1.1 degrees warmer than pre-1850 on average, and we already see at 1.1 degrees of warming that things are getting pretty bad, right? Just think about this last summer. About 1/3 of Americans, about 111 million people, experienced a climate-related catastrophic weather event. We're talking heat waves, hurricanes, wildfires, extreme precipitation that causes flooding, etc. Just in the US, these events have killed almost 400 people since June. So if 2 degrees of warming we know that 2 degrees of warming will be much worse than today, and 3 degrees will be probably about 4 times as bad as today in terms of catastrophic effects. So I don't think that it's likely that people will accept this, and that's why I'm actually optimistic that governments will inevitably do this, and this will happen. It's just that it would be better if it happened gradually and in a managed way than if it happens in a disruptive way. And I think that we all agree on that. The other thing I want to say is that, and this is something that I think about a lot, and I think that I noticed a fallacy in a lot of conversations around climate. And Henrik obviously highlighted that we are in a lucky spot today compared to where we were 20 years ago, because we've had some lucky breaks, meaning the costs of certain technologies have come down so much, like in the renewable energy space, for example, the cost of wind came out like 80 to 90% in the past decade. Same for solar, even more dramatic, to the point that today solar energy, as the IEA stated, is the cheapest form of energy ever available to humankind. I mean, that's remarkable, right? So we've been really lucky, and yet, as Aniket said, our emissions keep going up, and so there's clearly an insatiable appetite for energy, and we need to find a way to satisfy that appetite in a way that is, without carbon, basically. But the other thing I want to say is that, and here's the fallacy that a lot of times people make when they talk about these topics. So two things. First, transition risks, which are the risks related to moving our economy away from fossil fuels, are transitory. Once that transformation has occurred, it's done. But the physical consequences of climate change are locked in long term, basically forever in human terms. And things will only get worse if we don't address these issues. So that's the number one thing. The second thing is that the no climate risk of any kind scenario is a zero probability scenario. So when we do these analyses and we say, oh, but this is going to cost us X versus Y, what's the Y scenario? Remember, we only have two scenarios basically, and we're going to face a combination of these two. We have a scenario where we address climate change and we move the economy to net zero carbon, and that will cost us a little bit, right, in the intermediary period, but then we'll deliver an economy that is free of carbon and can continue. Or we have a scenario where we have unabated climate change and we got to live with the consequences. Most likely we'll have to deal with a mix of the two because the world's not perfect, but there's no other scenario available. There's no scenario available where we don't have climate change and we also don't have transition costs related to transitioning the economy to zero carbon. So these are the things that I just wanted to put out there. So now, having said that, how do we translate that, take all that and put it into something that allows us to essentially make products, financial products, available to our clients that reflect these realities? Because that's really where I sit, right? Aniket talked so eloquently about what he does. Where I sit is I need to basically come up with ideas to incorporate different data, and I'll talk about that, and information that's both quantitative and qualitative, put it into indices and products and make those available to our clients so that we can actually shift that money in the right direction, to my point earlier. So that's really what my role is. So let me talk about that. I think we're at the very beginning of this journey, right? Where Annika talked about ESG. I mean, I would say ESG is also different from the net zero conversation because it's been around longer. Investors have talked and thought about how environmental, social, and governance issues affect profitability or credit worthiness of a company for a long time. But I would say climate really has come into focus in the last few years. And there are ESG metrics and ratings have been around a long time, you know, obviously with differences between asset classes and stuff. But I would say that the metrics to really evaluate the risks related to climate and the opportunities related to climate are more recent. Now, having said that, we think, you know, we really believe that transparency around these metrics is important. And then when these metrics evolve and become good enough, then we can build indices and products around them. And to my point earlier, we can really make them available to our clients. So two things about this. First, let me also emphasize that, and I want to repeat this, that building net zero portfolios is not the same problem as building a net zero economy. Those two things are somewhat related, but they're not the same thing, right? So our role as financial institutions is try to think about how do we build these portfolios. But honestly, the idea is, can these portfolios reflect the broad economy? That's really where it's at. That's where the problem is, solving the problem in the real economy. So, I have no ambition of solving the problems in the real economy. So I'll do it in my little corner of the world, which is thinking about how to reflect that reality in portfolios. So that's number one. Number two, is there an actual standardized way of doing that? Not really. There are some frameworks that are evolving and and they're really important. So there's been a few that emerged over the last year or so that are really helping different types of participants in financial markets. Aniket was talking about earlier. There's a difference between asset owners and asset managers. There's a difference between banks and corporations. So those have different frameworks for reflecting that net zero reality into how to build portfolios that are aligned with that. So I want to say that. Now, in terms of data, I think all these frameworks basically agree on one thing, which is that you can't really just build net zero portfolios by getting out of certain sectors or certain or certain names or certain exposures, because ultimately, we want portfolios to be a reflection of the real economy, like I was saying earlier, and just divesting from some sector is not really going to deliver that. So that's number one. Obviously, it's an option, and it's a very legitimate option for an asset owner. It just doesn't solve the whole problem. So then, having said that, how do you measure? There are also some similarities in some of the recommendations around how do you measure this alignment and what metrics can you use. So I'll just spend like a minute talking about that. So the first and obvious is you need to start by measuring greenhouse gas emissions. You need to start measuring them at the sector level, at the company level, et cetera. There's a lot of different ways of doing that. Luckily, we've had the tools to measure that. The Greenhouse Gas Protocol has been around for 22 years. Is it easy? No. Has it become better? Not so much. The data is still kind of all over the place, although getting a little bit better. So, but we have that as a starting point. So that's number one. Now, all the metrics related to greenhouse gas emissions tend to be backward looking. They're like a snapshot in time, but it's typically like 2 years ago. So it's helpful as a starting point, but it's not super helpful in thinking about alignment. To think about alignment, you need some form of forward looking metric, something that tells you, okay, here's where the company is today. Here's where the portfolio is today. But where is it going to be in 5 years? Where is it going to be in 10 years based on the underlying emissions of these companies that are in the portfolio? And so we need some metrics to think about that. So things like commitments to decarbonize, science-based targets, there are very useful starting points for us to gauge the direction of travel of companies. Remember, momentum or trend is really more important than where we are today, because we ultimately know that we got to get to zero. And so that's really important. So some form of forward-looking metric is really, really crucial here. And then, of course, things like green CapEx spend or alignment of, what kind of businesses are you exposed to? What kind of revenues are coming from each of your businesses? Some fundamentals and also qualitative inputs tied to qualitative themes like transition plans that come from engaging with companies and knowing them intimately. I mean, Annika talked about equity research. That's part of, that's part of what that's for, but also engagement, obviously, is helpful in that sense. So then what do we do with this data? And then we kind of have to put it all together and think about how do we build products, financial products around it, right? And so when we think about what it means to invest in the climate theme, we identified basically 3 approaches to climate investing that can be used as foundational long-term holdings or as targeted and satellite exposure. So the first is, and I talked about this, to reduce exposure to carbon emissions and fossil fuels. So here again, this is I call this strategy the strategy that lets you sleep at night. I don't want to be involved with these things. I don't want to fund these things. It's great. It's a very legitimate strategy, and you can have products, and there's a lot, in fact, today that screen out certain sectors or the worst performers within those sectors in terms of emissions. So that's number one. The second approach, which is a little bit more sophisticated, is an approach of prioritizing companies based on climate opportunities and risks, which means reweighing them in portfolios based on how well they're riding the transition, for example, how well prepared they are for the transition, or if they're contributing positively to the transition, and if they are poorly prepared or underweight these companies in your portfolio. So that's the and then the third approach is to really target, and this is for parts of your portfolios, most likely not the entirety of your portfolios, but really target climate themes and impact outcomes. So you can zero in on specific sectors, think about clean energy, for example, or asset classes that represent opportunities in the transition economy. Think about green bonds, for example. So yeah, I'll just stop here as an introduction, and I'll give you back the floor, Claire.
Fantastic. Really, some really interesting points and some very salutary metrics to go with Aniket's definition of a sort of an existential or a systemic risk, and whether investors really can get their heads around those. Very interesting that you're linking the net zero portfolio with net zero in the real economy, which really important distinction there. So going to march on. We've now got Silvia Lamdor, who is Vice President and Portfolio Manager on AllianceBernstein's portfolio management team. She focuses on thematic credit strategies, and I'm hoping she'll talk to us a little bit about the fixed income side of things. We've had quite a focus when we talk about investors, and noting Aniket's warning that we need to be a little bit careful about that being an all-encompassing phrase. But we've had a lot of, with regards to the role of shareholders and the power that they've got to influence companies. But I think we're getting more and more acutely aware that most of the new money that flows into the economy comes from debt. So I'm hoping Selina will share a few thoughts with us now.
Sure. Thank you for your time, and sorry about my voice. So there's no doubt that the topic of net zero is becoming a huge area of focus for the industry. As part of our endeavors to be at the forefront of industry developments and really understand the science behind it, at AllianceBernstein, we joined the IIGCC in 2019. And this was the same year that we formed a partnership with Columbia University's Earth Institute. So all of our investors at AllianceBernstein, including myself, have gone through climate school to really understand the science behind all of these topics and look beyond the hype and the announcements and understand the implications of all these data points that are coming to the fore, as Laura mentioned. That partnership has since deepened, and we undertake various research projects in conjunction with the university. And we have made this into a two-way dialogue where ourselves as investors have received some training from the Columbia University scientists, but we have also provided them training for them to really understand the financial implications of some of the things that they are doing on their side. And we believe that provides for a stronger partnership to really help advance this agenda. Taking a step back, but beyond the hype, at AB, we've always believed that ESG integration is part and parcel of good fundamental analysis across the board. And I would actually slightly diverge from some of the points that have been made so far, in that thinking about transition for carbon intensive sectors is central to understanding ESG risks underpinning those sectors. Within the fixed income department at AllianceBernstein, we have an entirely proprietary ESG scoring model for both the corporate and the sovereign space. And those scores feed directly into the fundamental scores of our companies. And as far back as 2012, 2013, we have identified superior investment opportunities in the European utility space in geographies such as Spain and Italy. And a key tenet of that thesis was that those economies were transitioning faster into renewables. As Laura mentioned, she made a very valid point. Data is always evolving. And alongside most investors, we are becoming better at formalizing these new data tools to incorporate into our analysis. Data is also becoming more standardized. And so we can, we are more able to compare like for like across sovereigns or across different companies. More specifically on being a bondholder, we're often hear the talk that bondholders cannot engage as effectively as equity holders. I actually think it is completely untrue. Having been in this space for a few years now, one, even for the larger companies, many companies issue equity, once in a few years. A lot of these companies have to tap the debt market multiple times a year, and that gives us touch points to engage with them on their strategies, to try to push them to set these science-based targets, to try to push them towards the transition, etc. And then in the debt world, we can engage with more stakeholders, sovereigns. We have engaged with many sovereigns over the past year or so on their NDCs, understanding their NDCs, standardize them against a baseline, putting them within the context of fair share and just transition and so forth. We can engage with the securitized space. We've engaged with various agencies in the US to help them improve the disclosure on the energy intensity of the homes from which the mortgages are issued, etc. And then going further down the capital structure in the corporate space, in the high yield space, for example, there are many companies that can either be enablers of the transition through innovative technologies that are perhaps not that are perhaps not yet listed, but with whom we can provide access to capital. There are also in the emerging markets world, and this is a topic that's been brought up, a lot of quasi-sovereigns that are very often in highly carbon intensive sectors, in the oil and gas sector, in the utility sector, and so forth. And we can engage through this joint engagement with the issuers themselves, with the sovereigns, understanding the feasibility from the financial side to enabling this transition. We believe we can enact change. And then often in the bond world, a lot of our benchmarks are more exposed to those carbon intensive sectors versus some of our strategies run by our equity peers, especially those thematic equity peers who can perhaps just avoid the larger emitters. In the bond world, when we run these benchmark bond strategy, we cannot avoid those sectors. And so we have to be really thoughtful and think about, as Laura mentioned, forward-looking trajectories of these companies. And then finally, one of the ways that we can approach a transition perhaps a little bit differently in the bond world is through ESG structures. So those are green, social, sustainability, and of late, sustainability-linked bonds. So at AB, we invested in our first green bond back in 2015. And we were actually recently praised by one of the leading syndicates in Europe for being one of the first, if not the first, major US asset manager to take a keen look at this market. We have developed proprietary frameworks for assessing those. And alongside, choosing to invest or not in a green bond, looking at their sustainability credentials, we are also actively engaged. And when I say actively, it is on a daily/weekly basis with bank syndicates across the street to try and help define the market, put in safeguards and make sure that the issues that come to market fund the right types of projects. We were also very active in the lead up of the issuance of the first sustainability linked bonds. I mean, for those of you who are familiar with this structure, it can be a slightly more controversial one in that the funds aren't channeled towards specific projects, but it is one when those types of structures are structured thoughtfully from a sustainability perspective. It is a structure that we feel can have a massive impact with enabling the transition. Basically telling these companies, these highly carbon intensive companies, to put their money where their mouth is. And if they don't deliver on their sustainability plan, or if they choose down the line to start going into more carbon intensive type businesses, there is a direct effect on the cost of capital to those companies. And so we think in that regard, being really active in this market is extremely important. It is a market that is still nascent. And whilst the green bond market over the past 6 years has reached a certain level of maturity, where perhaps around, I would say 80% of the structures that we see have a decent sustainability characteristics, in the KPI linked bond market or the sustainability linked bond market, I would say at this point in time, around 80% of the issues that we see out there are quote unquote greenwashed. And so we are doing this very active work, engaging with the issuers, engaging with bank syndicates, engaging with other stakeholders in the NGO space and so forth, to really help shepherd this market into a place where it can really make an impact from a sustainability perspective and be an enabler of the transition, as opposed to an excuse for companies to greenwash and still make their way into sustainable type portfolios. So as part of our assessment framework for KPI linked bonds, that assessment framework is entirely proprietary. We look at the ambition of the KPI, the alignments of that KPI with a 1.5 degree scenario. We look at the structure. We are bondholders. We understand these structures, what a coupon step up means for the issuer, for the investors, for our end clients, etc. The magnitude of this structure, the timeline for this structure, etc. But also we want these issuers to make a commitment to transition their whole capital structure over time to this model, to really incentivize them to deliver over the longer term. So this is how we are thinking about it in a nutshell at AllianceBernstein.
Brilliant, and thank you for persisting with that. Your voice held out brilliantly there, so thank you. And such an important point around the emerging green bond market, and I think Laura picked up on the point about transition plans and how companies need to transition. So this whole challenge of how we get money into these organisations and make sure that it's going towards the right thing. So very important linking point there. So I'm going to call on our last speaker today. So Morgan Lamana is Senior Manager for Investor Engagements at Ceres. Morgan is focused on the implementation of the Climate Action 100 Plus initiative, which we've heard a little bit about, but she's going to talk further. So she's been responsible for supporting investor leadership on target companies and working with Ceres to track company progress. So this is transcending. We've heard actually some really ambitious ideas about how investors can play a role and why it's very much in their own interest. I think we have a few leading voices here. So this is now looking at how investors come together and the power of united engagement. So can I pass you over to Morgan?
Yeah, thank you, Claire. And yeah, thanks again. It's an honor to be here, and it's been great to hear everyone's perspectives so far. Look forward to the conversation, and also great to hear even just some of the optimism from the other panelists, because I know that you guys are really the ones, working on this and really understand, the scope of the challenge. So that's good to hear. So I'm going to go over a bit, kind of the origin story about Climate Action 100 Plus, just a little background on the initiative, and why investors collaborate at all. I'll talk just a bit about what has been achieved just since 2018 when the initiative was launched, and then a bit on how we measure progress of companies. So yeah, thinking back, as we're heading into COP26, I agree with Henrik, the world is a different place than it was 6 years ago as we were going into COP21. But I was reflecting today that, heading into the year COP21, the Christiana Figueres, who chaired the UNFCCC, and, in my opinion, one of the reasons we have the Paris Agreement, she really did a lot of outreach to investors and the private sector. I think understanding that companies or countries would not commit to anything that they thought would hurt their own economies. So she was very proactive in reaching out to investors, economic leaders in every country in the world. And one of call to action that she set out for the investment community before everyone met in Paris was to carbon footprint portfolios. So back then, I think we were more in the ESG world, assessing risk, and this was the way that investors were looking at, okay, what is the carbon emissions of my portfolio? So they would look into all the companies, add up the emissions. It was, a momentary shot in time. And so CalPERS did this, and what they saw was that 80% of the emissions in their equities portfolio came from about 200 companies. And so I think this kind of sparked the idea, if we were to engage the 100 largest carbon emitting industrial companies in the world, if they were just to reduce their own emissions by 60%, that would actually be enough to keep us on, trajectory with the Paris pathway. So, back then, I think 2016, 2017, Ann Simpson from CalPERS, was reaching out through the investor networks. I worked with Ceres. Back then, I worked with the European Investor Network to say, how can we turn the regional collaborations on engagements into a global collaboration? And why do investors collaborate? I think number one, it increases the impact with companies. They see that all investors are asking for the same thing. They can't say, oh, different shareholders want different things, so it's an excuse to not act. But it also increases the efficiency. And as Annika was saying, different investors have different, incentives, ways of working. For pension funds and asset owners, they might not have a lot of time and capacity to engage companies, so it was more efficient to band together. I think as the initiative has grown, so that started the sign-on process. At that time, several investors started to sign on. 4 years later, there's now 600 investors representing around 60 trillion assets under management. And just showing what a different world this is now. I think around 300 of those investors, around half, now have net zero targets themselves. So really, the investors coming into the room to engage with companies, are bringing that they're transitioning their own portfolios as well. So the investors agreed on an agenda. Climate Action has a common agenda asking for companies to improve their governance around climate risk, improve disclosure on climate risk, and also to take action to reduce greenhouse gas emissions. So this was the first kind of collaborative engagement where investors were actually asking for action. I think historically, investors in ESG initiatives are asking for more information to assess risk. This was really trying to group together to address the systemic risk of climate and actually change action, in the market, in the real economy. And finally, the focus list was chosen. So if I didn't mention that, it's about 167 companies that are engaged through Climate Action. So additionally, what has been achieved, as I said, the growth in investors. As the numbers of investors have grown, the types of investors have also grown, the geography of investors. There's, pension funds in Asia, Australia, Europe, US, South America, investors, active investors, passive investors. We see active investors actually engaging to make decisions on where they think companies are risky or not addressing climate risk. They're actually seeking to provide more capital, invest more in companies that they do think are managing the transition well. We see more and more fixed income investors. Selima was talking about engaging with companies. And again, pension funds, asset owners, as Annika said, they have different interests in different countries, different political realities. Even within the US, treasurers and pension funds might be looking at climate differently. But I think as more and more countries have set net zero targets, more and more investors and companies are following. Additionally, what has been achieved, I think shareholders are using their voice more. Just in 2021, we saw 5 shareholder resolutions get a majority vote that were on climate. That we're actually calling for companies to reduce emissions. I think that's, more than we've seen, all together historically, but all in 1 year. We also saw investors, seek to replace 3 directors on Exxon's board as part of the Engine #1 campaign. This was driven by, lack of performance, but also just lack of good governance by Exxon on their board, acknowledging that they did not engage with companies about climate over a number of years, that they had seen problems with financial performance, and just really acknowledging that no one on the board had experience in the energy industry, in a company in transition, and that really governance, was going to be necessary for the the oil industry as a whole, but especially Exxon. I think how are we seeing progress in companies? More than half of the 167 companies now have some sort of net zero target. Compared to 3 to 5 years ago, there were none of the companies had set that target. We weren't even really calling for it at that time. I think the IPCC report came out afterwards saying really to stay under 1.5 net zero by 2050 is what is necessary, and it's continuing to even ratchet up from there. And I think even just since those results were released in March, about half of companies having a net zero, we're seeing more every quarter as I mentioned, other countries make net zero commitments. China, South Korea, Japan, all setting net zero commitments. Led to a number of other climate action focused companies following there. And let's see, so how do we measure progress? It's really through the Climate Action Company Benchmark, which was first released in this year, March of 2021, and assessed all of focus companies. A second iteration will be released in March 2022. And it measures progress along the areas of the climate action agenda, as I said, setting targets. So not only overall net zero targets, but looking at short, medium, and long-term targets. And if they're aligned with the IEA, a 1.5 degree scenario, it measures companies' TCFD disclosure, scenario analysis. It also looks at their governance, how they're lobbying governments to support the transition. And then it also asks companies to set out climate strategies and to commit to align their capital expenditure, their future investment with their own targets that they have set. So I think I will leave it there and look forward to the discussion.
Thanks, Morgan. So I'm going to kick off the discussion. I completely misled everyone putting things in chat, but there's also a Q&A. Don't worry, put them somewhere. I'm going to kick off actually, probably not in the right order for this list, but I was going to pull Salima in if your voice is holding out enough.
Yeah.
Two questions for you. One was very, very quick reflection. I think you've been involved as an investor in the CA100 Plus initiative. Yeah. So I was just going to ask you sort of to give the investor side of the experiences there of CA100 Plus. And then we've got a question for you here from Paul Risman, that sustainability linked bonds and loans can really move the decarbonisation needle, but currently the associated incentives are immaterial. So what are you and other investors doing to embed more serious sanctions? Do you mind picking up both of those?
Sure. So to start off on Climate Action 100, as you mentioned, we have been supporters of Climate Action 100 since 2018, and we have been lead investors with many companies, including in the South African sector, one of the bigger emitters worldwide. One of the largest emitting utilities company worldwide is a South African company called Eskom. Eskom and Sasol, another South African company, are actually responsible of 25% of the continent's emissions. And we have been lead investors with those issuers to try and drive them to move the needle. In the case of Eskom, it is a company that doesn't have access to capital markets on their own. They are a highly levered business with, their operating revenue is lower than the interest expense. So they have basically zero firepower to spend CapEx on transitioning from a completely coal-powered business model into renewables. However, we are a large emerging market investor, and as part of that, we hold a large amount of bonds in the South African sovereign, who can provide the support to the state-owned utility to decarbonize. And so this, being a lead investor in this framework, has been very powerful because we can talk to many stakeholders to help move the needle. So we are in partnership with, we talk to Climate Action 100, we talk to other investors with us who are lead as part of this engagement, but we don't just have this one touch point with the company. We really try to understand the feasibility from a financial perspective and see how we can advance an agenda in a financially sustainable way. And part of that is engaging with the South African government. Part of our engagement with Sasol is they get their energy from Eskom, so their scope 2 is very high, goes through engaging with Eskom. And so it is really like a 360 360 engagements where we get the help and the assistance from the Climate Action 100. The engagements are non-confrontational, so we really try to make those those investee companies understand where we are coming from and try to help them. And Climate Action 100 is helping them define their sustainability strategy. And through our engagement as bondholders, we can help advance the needle, we can help move the needle.
Thank you.
And then on the sustainability linked bond question, so those structures are, they can be very powerful, but they are very prone to greenwashing also, and that's something that we recognize. When you issue a green bond, you have to have green assets to underpin that green bond. When you issue a sustainability linked bond, you don't have to have the assets, you just have to have a sustainability strategy. And we have an assessment framework that we developed that incorporates elements of materiality. Is that KPI material, i.e., if you're an oil and gas company or a utility company, you need to address your greenhouse gas emissions. You can't, materiality is the first and most important tenet of our assessment framework. But as part of our assessment framework, we look at the nature of the KPI, into materiality, benchmarkability, ambition. But we also look at the structure of the KPI. And as part of our assessment for the structure of the KPI is the magnitude of the ratchet, right? And it is true that sometimes the coupon only steps up by a few basis points. I was looking at an issue this morning where it was a 5 basis points increase in coupon for 1 year for a 3-year bond. That is not what we're looking for. As a minimum, we want around 75 to 100 basis points ratchet over the life of the bond. And we can play around with the structure when it kicks in, etc. But we really want it to be, we really want the magnitude to be significant. And this is something that we look at when we see a sustainability linked bond come to market. Sometimes we choose not to invest, or often we choose not to invest in such sustainability linked bonds when the ratchets aren't high enough, and we give that feedback to syndicates. When you are a large investor in those type of structures, investment banks value your feedback because they know that you are going to be buying those quote unquote valid sustainability linked bonds in size. And so the engagement isn't only with the investee company, it is with the syndicate desks as well. And we are also very active with various NGOs to help set baselines as to how this structure should look like. 6 years ago, the green bond market was pretty much at the same point, and it has grown, it has matured, still has some pitfalls, but we can, that we need to iron out. But it did get to a place where arguably it is making an impact. The sustainability linked bond markets, we are at early stages, but hopefully we take it towards to that same direction.
Fantastic. Thank you for that. We've got a few questions here, which I'm going to try and bundle together. I'm wondering if Anneke and Henrik might like to come in. I think we have one here that is about how do we unite the world behind an investment strategy when richer companies are more interested in providing resources for their own residents. And then I think we've got something around how we sort of control the effects of countries sort of offshoring their investment in green a little bit. How do we make sure they're decarbonising their companies as well? I don't know, Anneke, if you'd be comfortable to come in and talk a little bit more around some of these issues.
Yeah, look, I mean, a few things, great questions and really wonderful interventions from all the panelists. So Morgan and Salima, thank you as well for your comments. And Laura, of course, it was great. Let's just take a step back. Climate change is one of the great injustices, if not the greatest injustice that humanity has ever done to itself in terms of the distributional effects of this. A few parts of the world used a lot of it and destroyed the biosphere, and a large group of people didn't contribute effectively anything to climate change, but are going to suffer the worst of it. And so we all have to just accept that is where we are right now. And there's no real way to, you can't sort of logically explain it in anything other than the US, Europe, and now China has used way more than their budgeted amount. And there's some very good work from Professor Jason Hickel, who's one of my favorite anthropologists, who really looks at this question from a fairness perspective, going back from a historical cumulative emissions perspective. And so how do you do it? You need massive transfers. You need massive transfers of wealth from high income to low income countries. And everyone is of course focused on this $100 billion number, which is in some ways a straw man, because 100 billion is nothing. 100 billion is peanuts. And we need trillions of dollars to go from the high income world to the low income world in the form of grants and highly concessional lending, if we are going to solve this problem. And how do you get there? I mean, yeah, it requires appealing to humanity in a way that we have not been very good at. and some would argue goes very much at odds with how humans exist. But, our job, I believe very much my job, and others on the panel may have a different awareness of what their job is, but my job is to deal with reality and deal with the numbers and just be clear about what's needed. And for me, it's just absolutely clear that we need an enormous transfer of wealth that comes from high income to low income. And otherwise, all of these measures are good. None of this is wrong, right? ESG isn't bad. Climate bonds aren't bad. Green finance isn't bad. None of this is bad. But I'm sorry, you get to 3 degrees Celsius and you fail at the test, right? Like, we can't say when we get to 3.0, but at least it would have been 4 or 5, and now we only got to 3. So look at us, pat on the back. Like, that's insane. And I'm looking right now at the IPCC AR6 report. I have it up right in front of me, and it says that there's 500 gigatons left for a 50% chance at 1.5 degrees, right? So that's at 50 billion a year. If we include equivalents of CO2, that's 10 years. And if we take out the methane and all this, we're at around 35 billion a year, 35 gigatons. So it's around 16 years. The only way you get there is if there is this massive transfer. And unfortunately, there's no discussion around it. There's really no discussion, even in COP right now. Everyone in the report that came out today, it's about the 100 billion. The 100 billion is it's codified in the UNFCCC language, which is why we talk about it. But it's an absolutely insane small number that doesn't get anywhere close to solving this problem. So I think, the answer to the question is, we're not good at this. We have never done this yet. And this is why I am much less optimistic than Henrik is on where we are on this journey. And I'm certainly much less optimistic that we will get to below 1.5 or 2. And then the only other thing I'll say is that, the reality on the ground, yes, this question around the reality on the ground is very different. And the reality on the ground in most parts of the world is actually worlds that are carbonizing. They're going into carbon. They are not going away from carbon, and they're not getting the support from business or international community to solve this. And I'll just a final thought, and this is something I say to my clients all the time. I think the investor world, in quotes, the investor world would be would be well served if we were clearer about the temporal elements of our work, which is to say, are we actually serious about 1.5 or not? I think we need to be honest about ourselves now, even amongst in polite company. Are we talking about 1.5? Are we talking about 2? Or are we talking about 3? Because each one of us, the interventions from investors and from corporates and from governments are different if we talk about one versus the other. The people who are talking about 1.5 still, 1.5 aligned world, they have to explain to me, how do we wean ourselves off of CO2 in 10 years when we have at least $1 trillion a year still going into fossil fuel investments per annum, by the way. I think that it's one thing that I ask actually of my clients and of the broader investor community for just a little more clarity around what our end goal is. Because then banks like Jefferies, asset management firms like BlackRock and others can start designing portfolios that respond to what the goal that we actually have in mind.
Thank you. And I'm very quickly, Henrik, you've been accused of being overly optimistic.
Wow. That's
I think
that's not a normal thing. No, I don't think I'm overly optimistic. I'm saying this is what needs to happen. And I think instead of doom and gloom and saying everything is bad, we say, well, we actually have a lot of the solutions, but it needs policy changes, it needs perception changes, it needs action changes all around the system. But I think it's an important thing. I put in, I hope that everybody can see, we wrote a blog like approximately a month ago with our new energy strategist, Kingsmill Bond, about ahead of COP. It is really about, we need to change this, that this is all pain and it's all like 100 billion here and 200 billion there. It's like all of these are petty investments compared to the $3, $4, $5 trillion we need per year. So all of these $100 billion, it's just some noise that everybody needs to figure out. We need massive change. We need it now. We need to change our perception, our view. Banks need to realize that most of the stuff they have on their balance sheet are not worth what they think it is. Investors need to understand that they can lose money, and all of this here is going to be very painful unless we really start to look and adjust our system. But we have also opportunities. Solar, as mentioned, I think it was Aniket or who also mentioned, well, solar is now the cheapest energy source we ever had exposure to. And we have massive amount of space we can put this in. And compared to today, where really the wealth concentration is very centered on a few fossil fuel producers, all of these countries that really need to decarbonize, they have lots of great weather. It is as a paradox. I'm from Denmark myself. It's kind of windy up there, but Germany being a big solar power country, it's kind of oxymoron to a large extent. But that is how we're doing it. And also part of the solution is, well, the richer countries, they have developed a lot of the technologies, and they can go and deploy and invest them into other areas where they have much cheaper access. We're not going to build a lot of solar and hydrogen plants in the middle of Germany. There's no space, but we can do that in Africa. We can do that in other places where we have better renewable sources. So I think the key point for people is we actually need to say there are solutions, but we need to grab them and we need to change and change the perception.
So actually some really vehement agreement there, but it may be a positive and a negative spin on the same point. Salima, can I call you in very quickly, and then I want to bring Laura in on another question that we've got there.
Yeah, I mean, I just wanted to chime in to rejoin some of Henrik and Anniket's point. Yes, emerging markets, as they advance their social agenda, you can arguably think that their environmental footprint is going to increase, and it probably will. However, I mean, there was a really interesting report put out by Carbon Tracker a few months ago, actually, on emerging markets leapfrogging on the technology side. And it is something that we are seeing on the ground in various places. India is investing massively in renewables. We've just come out of the IMF meetings last week, and a country like Gabon, who has been really, historically an oil producer, in the forward-looking plan, they see the oil as being a stranded asset, and they are investing in natural capital, recognizing that they have a resource of value that they can transform. And in emerging markets, we are not where we should be probably we won't be within the next 5 years, but we are seeing a recognition of the urgency of the challenge, and we are seeing the start of concessional fundings going towards these economies to try and advance the sustainable agenda. And it's something that we welcome, and it's something that we need to help enable as investors. Thank you.
And that's a great point, links back to Laura's point about the role of government, and I think really echoes Anniket and Henrik's points about the need for speed. Laura, can I pull you in? We've got another question here I just would like to cover around the moral hazards. If I can find you, if you're still there. And I'm going to throw this one to you. I think we heard from a few panelists that there's something about creating proprietary products and being able to bundle things into a form where you can then sell it. Slightly unfair to ask you this one, but the marketing of ESG becomes more of a focus than the execution of sustainability into the core business models. Have we got a moral hazard there if this becomes big business and maybe takes the focus away from the real economy? I think you were making some strong points there that we need to link these two quite carefully.
Yeah. So yeah, I definitely think that asset managers need to be very clear about what choosing ESG means, right? What electing to perhaps shift your asset allocation from more traditional index exposures to ESG or climate versions of those exposures. What does it actually do, right? And that's why I think that we are pretty clear about that. So when I talk about the climate framework, right, when I say it's perfectly legitimate to not want to be funding certain activities, say coal, for example, or fossil fuels more generally, does that actually change the world if you divest those from your portfolio? Well, most likely no, right? Well, I guess it matters at scale after a certain amount of years. And, we're starting to see some of that today. Certainly the decisions of large asset owners such as endowments and some of them because of student pressure, et cetera, including Harvard and others, to divest from fossil fuel. I think that has mattered a little bit for prices in the market. But is it actually going to reduce emissions in the real world? No, and I think we're very clear about that. So I think moral hazard, look, when I talk about what we do, I always say this, this is a world that clearly we're at the beginning of this process. There are not just now, we're starting to see sets of rules and standards and labels and clarifications from a regulatory perspective of what it means to say that something's ESG, that something's sustainable, et cetera. So we're at the beginning of that, which is great, by the way. And I think it's really important that regulators play a role here and that, we have some certainty around this. I think that gives comfort to a lot of our clients. But I think, when I think about what we do, we just don't have the luxury of risking our reputation on something that we can't stand behind. So that's something I think about a lot, right? We need to be rigorous. We need to be honest about what we're doing. And so when we put something out there that we represent in a certain way, we want to make sure that we can stand behind it. So obviously that's a way. Reputational risk is a way that you solve for a little bit of that moral hazard, I think. And certainly in our case, we have a lot to lose. So that's something that's front and center.
Thank you for that. And I've got one last question on the whole developing world, the divide that's been identified in a number of the questions. Morgan, just 2 minutes from you, because we are very short of time. Are you seeing much engagement in CA 100 plus from investors in the other part of the world and in some of these nations? Is it a very Northern Hemisphere initiative?
No, thank you, Claire. Yeah, and I appreciate Salima bringing up the example of Eskom and Sasol in South Africa. I mean, it's shocking to know that that's 25% of the emissions of the continent. So I think that and a few other things I've heard today really do show the kind of magnitude of the inequality there with the emissions. But yeah, absolutely. I think when the initiative started, there is this kind of history or infrastructure has been there for many years of these kind of collaborative engagements. Primarily in Europe and then the US, kind of built more around shareholder resolutions. But I think since the initiative launched, there's focus companies, everywhere in the world. I think more and more local investors have gotten involved in all of those engagements. And it does make me think, just this conversation, one of the things I said, how we track progress in climate action, emissions was not one of those things. We're not measuring the emissions every year. And I think that's partly because we do realize they will go up, and peak in the near to medium term future, hopefully. But it does make me think you have different sectors, or that maybe there is a common but differentiated responsibility in terms of when each company's emissions are peaking. And it's something we want to think about in the next phase.
Thank you for that. And I know you're introducing a just transition indicator to the benchmark, which is an interesting one. I think we are going to have to close now. I could talk to these guys all evening, but I think I have to hand back to Brooke. So I'll say my thank you to Henrik and Aniket, Salima, Laura and Morgan. I think they've been fantastic interjections and have covered a whole breadth of this topic. And thank you for joining. I think if people have got questions after the event, please ping them through. I'm sure there will be a route for that. I don't know, Brooke, am I supposed to hand back to you before we close, or?
Yep, I'll quickly close, but again, I also could listen to this fantastic panel for a while longer. But I think, we've at least sort of whet everyone's appetite to delve more into these issues. So thank you very much for all of your time. And thanks to everyone who joined our entire conference. we'll have it on our website in probably panel segments. So anyone can go back and revisit specific panels or issues. But a big thanks to my colleagues who helped organize, to all the moderators who were so fantastic, and all the speakers who gave us a bit of their time and insights into these really important topics. So thanks again, and wishing you all a good week and hopefully a successful COP coming up as well. Bye.
Thank you.